Moody's says that the United States credit rating remains AAA and stable. There were some fears out there that the U.S. could lose its rating. That's part of what contributed to yesterday's market sell-off after S&P lowered its outlook on the U.K. to negative from stable. On the phone right now is Squawk icon and rebel Mohamed El-Erian. He's PIMCO's CEO and the co-chief investment officer. Mohamed, it's great to talk to you today.
Thank you, Becky.
Yesterday, your partner, Bill Gross, was on, and he made some comments to Aaron on Street Signs talking about how what was happening out there. There is a real concern about the outlook for the United States. You want to weigh in on that?
Yeah, I mean, what was really striking, Becky, yesterday it was not only the scale of the moves, but the fact that every market that carried U.S. sovereign risk sold off in a big way. And that speaks to what I call the neighborhood effect, which is that all the markets exist in a neighborhood, and it's a AAA U.S. neighborhood, the best in the world. And if people start questioning the neighborhood, and that's what happened yesterday, if people start questioning the neighborhood, then we're going to start putting a risk premium across the board, and that is consequential.
Although Moody's came out and said, forget about it, we think that this rating and the outlook remains very stable. The rating's still AAA. So does that shoot down the concerns?
You know, as Bill said, it's not an issue of whether the rating changes now or change in 3 years' time. It is whether the markets start pricing in some change. This is all about incremental stuff. And the big lesson, Becky, from the crisis we've been in is that it morphs. It morphs from one balance sheet to another. And the concern out there right now is that the next area that it may morph to is the public balance sheet. And that's what everybody's looking at. And this is a big issue. And we just have to keep it on the radar screen.
If that's the case, I mean, you've been watching this, we know, for some time. I mean, is it really getting worse? Is it just the market's perception that there could be some weakness there? It's just spreading through the market.
No, it is getting worse because the short-term policy imperatives conflict with the long-term policy imperative. So the short-term policy imperative is to stabilize the system, and that has worked well by adding government debt, by employing the government's balance sheet. The long-term policy objective is to have a sustainable public balance sheet. So at some point, there's going to have to be a transition, and what the market is warning, saying, don't wait for too long, because the public sector dynamics are getting worse. And this is a big issue because the U.S. supplies the reserve currency to the rest of the world, and the U.S. supplies the deepest and most predictable financial markets.
But Mohamed, it seems like just the other day we would talk to you about whether or not the government had done enough, right?
Right.
And you would say, not yet, not yet. It's necessary but not sufficient. When did we cross the line?
Well, there's a couple of issues. What the government has done very well is in stabilizing the short-term funding market. And we see this in what's happened to LIBOR. We see what's happened to the TED spread. We see that, as was said earlier, credit is flowing, that people are able to issue in the investment-grade market, in the high-yield market. So we've had a stability come back to the financial markets.
So they did the job.
They did the job, and at some point they're going to have to exit. What the market is saying is, give us a clear indication of how we're going to exit. Give us an indication of how we're going to get back to a market system, as opposed to the government being dragged in more and more and in more sectors.
Fickle market, right?
Sorry?
Fickle market.
Well, the market looks at short term and then once in a while steps back and says, okay, we're on a journey. What does the destination look like? And yesterday was a warning sign that people are starting to worry about the destination. It doesn't mean we get there immediately. We're still on the journey, but it means that the government has to navigate this very delicate balance between short-term imperatives and long-term imperatives.
Mohamed, good morning. It's David Malpass. I wanted to ask you about the crowding out effect, the idea that as the government borrows more and more, there's less for the private sector to borrow. In the 80s, people thought, well, there was enough to go around, plus the government was doing deficit spending in part to do tax cuts. Now we're doing deficit spending largely for bigger government. Does that have an effect on the private sector, and what is that?
David, it will have an effect. It doesn't have an effect right now because there's a lot of money on the sideline, and the private sector is in a balance sheet contraction mode overall. But over time, it will. The numbers, if you look on the public sector side, the numbers are very large. We're looking at very large deficits, 12% plus of GDP. We're looking at a debt stock that starts at 60% of GDP. And we're looking at an average life of the outstanding debt that has fallen to 48 months, the lowest for the last 30 years almost. So the starting point is not great. And the crowding out issue is going to be an issue, but I think it's down the line, David. I don't think it's immediate, and that's why it's important to figure out what the exit mechanism is going to look like.
Mohammed, you have these conversations with us, and you're talking to the viewers at this point, but we know that PIMCO has a lot of conversations back and forth with the government, the administration as well. Is this something that you've pointed out to people in the administration, and what's the response been?
I think the administration understands, and you saw this from Tim Geithner's public comments yesterday. On the one hand, he said there will be a time when we will talk about exiting, but that's not yet. And then later on, he said it's very important that the administration and Congress commit to a sustainable exit situation. So I think they understand, but it's a very delicate balance. Part of the problem we're in right now is that there is no perfect solution. And you've heard me say this over and over again. All of us have to worry about the unintended consequences of policy action as well as the intended consequences.
Are there unintended consequences from this legislation that is expected to be signed today on credit cards? Do you worry that means the banks will yank credit away from a lot of Americans, take it straight out of their pockets, or do you think that's just talk coming from the banks?
No, I think the banks are torn. On the one hand, they want to rehabilitate their balance sheet. On the other hand, they want to extend credit. There's also questions about the overall environment in which they are operating. So every sector, Becky, you look at is having this tug of war between what it should be doing, what it ought to be doing, and what people expect it to be doing. And that's what's playing out in virtually every market right now. And that's why you get this volatility that we have been experiencing for the last few days.
All right, Mohammed, thank you very much for calling in. We know it's early, but we appreciate you getting up with us.
Thank you.